Brad Williams, Frugal Finance, 4 steps to building a strong investment strategy. Successful investors and managers often rely on a well-defined, measurable, and repeatable investment strategy. Yet, many investors frequently shift from one investment to another without giving adequate attention to creating a structured approach. To achieve consistent results and make decisions based on logic rather than emotions, having a clear strategy is essential. The following steps outline how to create an investment strategy that is suitable and effective, helping to avoid a scattered approach where individual investments lack a unified goal or theme. Key takeaways: crafting a sustainable investment strategy requires a written plan that can be communicated clearly, benefiting both individual investors and professionals working with clients. Great investors have well-founded beliefs about market behavior and use these insights to inform their trading approaches. A solid strategy should be resilient, able to perform well in diverse market conditions, even if it's particularly effective under specific circumstances. The strategy should be measurable against a benchmark such as the S&P 500 to track performance and adjust as needed. Put it in writing. The first step in creating an effective investment strategy is to document it. As management consultant Dr. Deeming famously stated, if you can't describe what you're doing as a process, you don't know what you're doing. Writing your strategy forces you to articulate your approach and ensures clarity. By doing so, you can verify whether it's aligned with long-term objectives. Having a written strategy serves as a reference when market volatility strikes, reducing the likelihood of emotional decisions. If your goal shifts or your identity flaws, it provides a framework to revise and improve your approach. For professional investors, this also offers transparency to clients, building trust and potentially enhancing retention. Define your benefits. Successful investors base their strategies on core beliefs about how markets function and what drives the value of investments. Consider questions like, what gives me an edge over the market? Or what makes my strategy unique? Your competitive advantage could come from a specialized industry knowledge, exclusive research, or recognizing market inefficiencies, such as undervalued stocks with a low price to earnings ratio. Once you pinpoint your advantage, develop a plan to capitalize on it consistently. This plan should include both buying and selling rules. It's important to remember that advantages can erode as others adopt similar strategies. Alternatively, if you believe markets are generally efficient and no one can outperform them consistently, passive approach, such as investing in index funds, might be the most effective way to minimize costs and taxes. Ensure reliance. A strong investment strategy must be adaptable across various market environments. While it's common for strategies to perform well during certain market conditions but falter during others, the key is to understand your strategy's strengths and weaknesses. This understanding helps you maintain confidence in your approach even during challenging times. Moreover, diversifying your strategy can mitigate risk. For example, combining value and growth investing strategies can offer protection against changing market cycles, ensuring that your portfolio remains robust through both upswings and downturns. Market performance. You refine and assess your strategy. It's crucial to track its performance against a relevant benchmark. Without measurement, it's nearly impossible to understand what's working and what needs adjustments. There are 2 common types of benchmarks, relative and absolute. A relative benchmark compares your performance to a passive index like the S&P 500, while an absolute benchmark sets a specific return target, such as 6% annually. In addition to returns, consider the risks associated with your strategy. Assess the volatility of your portfolio's returns and compare them to your benchmark. Advanced metrics like the Sharpe ratio or Trainer ratio can help you measure returns relative to risk, providing a more nuanced view of performance. Conclusion: the most successful investors have a deep understanding of market behavior and the factors that influence investment values. By creating a thoughtful, resilient strategy and measuring it against relevant benchmarks, you can improve the consistency and success of your investments over time. A clear and repeatable investment strategy is key to achieving long-term financial goals. Comment if you have any tips, if you have any advice on successful investment strategies. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.